Ladies and gentlemen, today I want to share some insights into an investment strategy that leverages industry momentum, specifically the approach of buying industries on the rise while shorting those that are declining. When speaking about returns in this portfolio, or in this presentation, I will be referring to excess returns. First, we rank various industries according to their average returns. From this analysis, we can identify the top 15 industries and compute the average returns of those 15. Conversely, we do the same for the bottom 15, those industries that have underperformed. The crux of this strategy lies in constructing a portfolio that longs the winning 15 industries while shorting the losing 15. Essentially, we sell the losing stocks and invest in the winning ones, hoping for a trend that continues in the same way into the future. The return of this industry momentum portfolio is calculated by taking the returns of our winning 15 in a portfolio and subtracting those of the losing 15 in another portfolio. As you can see there, in our tables on the left-hand side, we have the average monthly return of the winner portfolio much higher than the average monthly return of the loser portfolio, and we can find the return of the momentum portfolio by subtracting the loser portfolio against that winning one. Interestingly, whilst the winning portfolio boasts the highest average excess returns, it does not have the best Sharpe ratio. This indicates that although those top industries can deliver substantial above-market returns, they are also accompanied by greater volatility. In contrast, the industry momentum portfolio has been shown through our analysis as well as multiple studies that it does not necessarily provide above-market returns, and in fact it does not produce much alpha at all, certainly not significant alpha, as you can see on that table there. However, the momentum portfolio's risk-adjusted returns are higher than the market. For risk-averse investors seeking stability, this insight is crucial. If you prefer a portfolio that shields you from the highs and lows of the normal market fluctuations, then the industry momentum portfolio may be the wiser choice than simply the market. The industry momentum strategy performs at its absolute worst when the market does not follow normal trends. For example, in the GFC, many industries experienced significant negative returns from the outset. However, these were precisely the industries that in turn experienced a substantial recovery following the GFC in 2009. The momentum portfolio performed at its worst in these circumstances because it assumes that industries that performed poorly in the past will continue to do so into the future. In significant global economic shocks like the GFC, this is often not the case. The momentum portfolio continued to short industries that had taken a massive hit during the GFC, even as those very same industries rapidly recovered. This exacerbated the losses in the momentum portfolio, as you can see on that graph below. Finally, I want to touch on how we can further refine this approach. Through a comparison of the risk-adjusted returns depending on how many industries we sort into winners and losers, we can find the optimal portfolio for risk-adjusted return. In this case, longing the top 13 industries and shorting the bottom 13 gives us the best portfolio with regard to risk-adjusted returns as measured through the Sharpe ratio. Shorting significantly fewer industries can greatly increase the average excess return, but it will also expose the investor to a much higher level of risk and volatility. So to conclude, the momentum strategy will often not beat the market with any regularity. However, if an investor is aware that the strategy is suboptimal during and following a significant economic crisis such as the GFC, the momentum strategy returns can be maximized. That said, the momentum strategy will nonetheless often fail to beat the market even if fully optimized. This strategy is therefore most appropriate for risk-averse investors, as the greatest value add that the momentum strategy can provide is in its risk-adjusted returns as opposed to its average excess returns. For risk-averse investors, the lower average return may still be attractive when considering the higher Sharpe ratio. The volatility of the market portfolio, even with its higher returns, may be off-putting to such investors.